Good morning. Hello, everyone. My name's Dan Murphy. I'm a correspondent at CNBC International, and on behalf of our panel, I wanted to warmly welcome you to our session this morning for what I hope will be a very insightful and informative conversation about the state of fintech in Asia and the world today. So, in preparation for the panel, I've been looking over some numbers, and I think the 21st century certainly belongs to Asia when it comes to a fintech perspective, and the numbers really speak for themselves here. Asia will account for half of the world's population by 2050, and this area alone is going to be home to more than 1 billion new consumers in that time. At the moment, half of the total global investment in financial technology is actually right here in Asia. So what we're going to do today is focus on 3 core questions that explore and analyze those trends for you. We're also going to discuss the impact of fintech on financial inclusion, access to capital, transparency, and compliance. So I hope to have a forward-looking discussion that helps you walk away with some compelling and actionable insight. So joining us this morning on our panel is a group of people who have a very deep level of knowledge in this field. So please make them feel welcome. Mr. Sapnendu Mahanti is Chief FinTech Officer at the Monetary Authority of Singapore. Sapnendu, welcome. Mr. Nin Tang is the founder and CEO of Credities. Long Chen is the Chief Strategy Officer at Ant Financial. Jonathan Larson is the Chief Innovation Officer at Ping An Insurance. And Simon Long is the founder and CEO of WeLab. So in answering our first question, it's this. How has fintech alleviated various frictions and difficulties of traditional and costly financial tools? So in November last year, the team over at McKinsey put together some research on this topic, and they published a report called Bracing for 7 Critical Changes as Fintech Matures. And the research basically looked at how the fintech industry itself is maturing and entering what they called a rapid period of change. This is what the report said. This new fintech era is being shaped by changes in market conditions, new regulations, and shifts in consumer demands and behaviours. The analysts also said, as a result, the industry generally is becoming more cautious, even as it becomes more diverse across technologies and products. So my first question to the panel, after all of that, is, how would you characterise the growth of this sector so far, and where are we at? Sapnendu, I'd like to start with you.
Okay. I thought I'll be the last one talking as a regulator. So let me put a broad last 2 years of my understanding of fintech. We have seen remarkable positive growth in getting fintechs, primarily the innovators coming from outside and trying to help the industry to grow and re-architect, reimagine in a much broader sense. So some areas they have definitely done very well when it comes to retail pain points, where they have solved largely the payment issue or lending challenges and all those B2C or C2C area. What we have encouraged out of Singapore is largely to go beyond that complex, beyond the simplified B2C segment to a more up the value chain, the B2B segment, which has, if I have to do in a scale of 10, which is way below the ranking I'll put. We still have a long way to go because that's where the more complex issues lies in the sector, the risk management, the capital market infrastructure, the deeper in the insurance side, the pricing side of the insurance side. I think that's where we want the fintech to grow, and that's a challenging segment for fintech to get there because it needs deeper expertise in terms of business, need a much deeper technology expertise to apply those to those business needs. So that's where we see a challenge, but that's where we see the future growing more in the space of fintech. Now that's the business view. In terms of the ecosystem itself, we have seen a significant growth in the risk capital, while we believe it's not enough being done because the ability for fintech to raise a lot of the early stage capital is still a challenge, primarily because the fintech themselves don't have good access to research of what they're doing, and so that they can get enough risk capital in that segment. But I have been told that there are enough money. So there's a bit of, if you talk to the investment side, they say that we have a lot of money. We don't have good ideas. If you go and ask the fintech, they have a lot of ideas, but they don't understand. So there's a bit of mismatch there. So, but if you look at the investors, they're overindulged in certain segment where it's easy to understand, the retail side, a lot of customer, big platform, put a lot of money there. But they're underindulging in areas which they really don't understand the deep technology and the deep business challenges they face on up the value stream. The last piece is the talent itself. This industry suddenly has a huge talent deficit because traditionally in the banking industry, we had a certain kind of talent who were good for that large enterprise, slow-moving giants. But now it is much more nimble, much more agile, and the kind of talent we need don't exist that much in this market. So you are facing a significant talent crunch in this broader ecosystem.
Okay, so you might be in luck because I think the former head of Citibank said recently that 30% of traditional banking jobs are going to be axed as a consequence of the rise of fintech. So you could be in luck with securing some new talent.
Now, we may have to repurpose those talent and hire them in the fintech industry.
Okay. Simon, what's your view?
I think from what we've seen in the last probably decade, the beginning of fintech, moving on to today, right? I think what started off is a lot of what we call business model innovations, right? A lot of platforms, P2P, moving what they're doing today offline to online, right? And then we've seen it evolving in the last probably 5 years or so into a more technological innovation. Meaning with those transactions happening, with those insights gathered, with those working in large institutions, right? How did these companies actually move towards the technological side of it? Now, it's actually very, very interesting because if it is a pure business model innovation, or it tends to have not a lot of entry barriers, right? Business model innovation, the nature of it. But once you go to technological innovation, you need to invest in R&D and stuff like that. And also, what we see is in addition to the entry barrier, right? You also make the ecosystem, yourself and others. So going back to what you said, the B2B and the B2C, you can make the B2C side and also the B2B side more efficient as a whole industry. So we're actually seeing how the technological side building up only in the last 5 years or so in a lot of these fintech companies with this focus.
Ning Tan, have you got a view?
Yeah, actually 11 years ago, Credit Ease invented P2P marketplace lending model in China, and then in about 10 years grew that to $1 trillion industry in China. The way we look at fintech is that payment and marketplace lending, these two sectors are more mature, but there are other areas like insurance tech, like crowdfunding, digital wealth management, robo-advisor, so on, are coming. Yeah, so future 5-10 years will continue to be very exciting. And also talking about like a B2C, B2B, you go to Silicon Valley, it's more kind of B2C. People don't get dressed like this. But if you go to New York, it's very much like, wearing tie, suit, kind of, B2B, more and more fintech, VC, we start to see. And so I think the future will be, more exciting than what we have experienced in the past 10 years. And also talking about like VC money, I think VC investors start to realize that fintech is really not so much internet kind of top line growth oriented, but it's more about risk management, finance experience. So in the past, you see a lot of like 20, 30 years old, like young internet entrepreneurs doing fintech. Growing top line very well, but in many cases overlooking risk management. That's changing, yeah.
Just to go back to the point that I made before about the analysts over at McKinsey saying the industry is growing more cautious as it matures. Why do you think in China this payment thing has taken off so quickly, whereas in other markets it's been slow to adopt?
I think Professor Chen has more to say, but I think for payment, quite a different marketplace, actually. That's a bigger question, like the US fintech, China fintech. Sometimes people say, hey, China is bigger, US is bigger. Actually, I don't think it's a logical comparison because these two markets are so different. For example, like China still today doesn't have a very established credit system, right? U.S. like a very established credit system. So China is catching up, in many regards. Like we are behind several decades, right? So we are catching up. So of course the market potential is much bigger. We have no legacy, and we are behind simply. So I don't think it's like a good apple-to-apple comparison. We do like a fintech investment in the U.S. We say, hey, their fintech companies, like payment companies, can charge very high fee, but in China, a super competitive marketplace, Professor Chen offers it for free. So of course, like very difficult for people to do this business. Yeah, very different market dynamics.
I don't think he offers free, he's subsidized for something else.
Yes, yeah, they are looking for the future.
Okay, so we better bring in Professor Chen on this. What is your thoughts? And can I also ask you, what's the difference between tech fin and fintech? This has been a bit of an issue of contention lately.
Yeah, I think one of the most interesting things about fintech is that different people actually, when talk about fintech, they mean different things, but they thought they're talking about the same thing. And I think the most important, the fascinating feature about fintech so far is the sheer size of scalability that already happened right now. So just give you some historical perspective. I remember I read in World Bank report in 2014 on inclusive finance. It says that Kenya was the best country using technology to promote inclusive finance because it took Kenya 4 years to cover 14 million mobile users. But before the Kenya's case, probably we would think about Grameen Bank. It took like 40 years to cover several million people. But right now, if you look at China, and for Alipay, it took us a bit more than 10 years to, right now we have more than 520 million active users. You look at the case of India, Paytm. It took India about Paytm 2 years to add more than 200 million users. So these are unprecedented in human history in terms of the financial inclusions. That is already happening in China, but it's not, and in India, in Kenya, or in these emerging markets using the fintech. But what's interesting about if we compare with the United States, so I think I've been to travel to US a lot. The most to talk about is the blockchain. Blockchain is great, but I think most of the people in the United States, when they talk about fintech, they're talking about a prospect of fintech, what could happen. And in emerging market, we are witnessing what is already happening. So it's quite different. I think, and it's so fascinating to look at United States. It has such an advanced financial system, and in using their own words, very outdated payment system. And they also charge like the merchants like 3-4%. Like in China, it's not only hundreds of millions of people actually using mobile payment. It becomes part of their life. It's so convenient. If you get out of China so inconvenient nowadays. And also, it's not only accessible, it's also very cheap. The industry charges about 0.6% or even lower. So I think this is what I'm trying to say is that tremendous progress thus far has made on financial inclusion because of the fintech. And that's very different between the emerging market and other markets. We're talking about different things.
Jonathan, let's bring you in on this. Just your thoughts on the state of fintech today, where we're at, and what's been the most, I guess, dramatic change that you've seen in the sector in the time that you've been working in it?
Well, I think it varies dramatically across the world. And I think in the US, we've seen 3 sectors that have been commented upon, which is wealth management, where we're seeing a very small number of players like Betterment and Wealthfront try and take position, but it's a very, very slow burn. We've seen payments, and probably the most successful outside of China is PayPal, without question. And then, of course, you're seeing the P2P lending market. And again, I think in China we've seen a far more rapid growth of that market than we have anywhere else in the world. And frankly, I find the models outside of China to be not particularly attractive economically, and certainly relative to some of their valuations. I tend to take an institutional perspective. At Ping An, I think it's a very interesting case. Many Western institutions feel constrained by their legacy technology and by the regulatory environment that they live in the post-crisis world. Certainly the one I used to work for is a case in point. At Ping An, I think the attitude is extremely different. And we have 400 million digital users across all of our platforms. We have our own cloud environment. We have to as a regulated financial institution. That's allowed us to think in a completely different way. The company invests about $1 billion a year in R&D. We have, for example, I think world-class facial recognition. We've done, I think, more facial validations than anybody else I'm aware of in the world. We've done 300 million so far. And when you log into Ping An Bank, or if you take a loan from us, or interact with almost any of our channels, we will match your face against a government database of faces. That, combined with your ID number, plus just some other circumstantial data that we can easily gain. So, for example, the mobile phone you're using pretty much gives us the ability to eliminate identity fraud. So that's a very simple example. At Ping An, 95% of our underwriting in our insurance businesses is automated today and doesn't touch human hands. When you get auto insurance, 90% of the deals are originated either directly by you or even by the agent or broker on a mobile phone platform with no paper involved whatsoever. It's a completely digital experience. There are dozens of examples. We actually have a live blockchain platform that we allow 200 banks in China to trade assets and liabilities on every day, which we built. We could have built it on an Oracle database, by the way, but the attitude is we refuse to be intimidated by technologies. It's about knowledge and skills, and the cost of building that was frankly insignificant relative to what we were trying to achieve. And I think increasingly as we look forward, we think of our identity as a company, as a technology company, increasingly first, and as a legacy financial institution second. And our model is very much how can we use technology to create client solutions in our traditional businesses and looking forward across a much broader range of fronts. So we think of our cloud as a physical environment that would be very similar to the Ali Cloud or the AWS or Azure or something like that at a physical level. We then have a client level where, of course, for our user base, consistent with law and client permission, we are trying to assemble as full a picture as we can on everybody we touch. We have an application layer to run the different businesses that we're in, and even services in the government sector or the health sector that we're supporting as well. And then we have an API layer, and that API layer has a lot of our own content. It could be our credit scores, our fraud scores, our driver scores, because we have the largest telematics driver platform in the world for our car insurance business. So we expose a lot of those APIs internally and consume them across our businesses. But increasingly, we're able then to expose them externally and make them available to partners of any kind commercially within China, even for free sometimes within China. And as we look to invest with partners around the world who have interesting technologies that can add to our mix, our value proposition is to be able to host them within our cloud environment as an API, be able to consume that API within one or more businesses, depending on what the nature of the opportunity is, and then to be able to work with those partners to market their value into China. So it's just a completely different mindset from what you're going to see probably at most Western institutions.
Okay, so I have a whole lot of questions to ask you all about cryptocurrencies, blockchain, and the future of money, and we'll get to that in just a moment. But to go back to our central question that we're trying to answer right now, what do you think are those core frictions and difficulties that that exist now in the finance sector, and what is FinTech doing to solve them? What would you say that the frictions and difficulties are?
I think you've got a great example just in the last week with the Equifax situation in the United States. I think it was 145 million names stolen.
Massive breach.
So how can that even happen? Basically, you've got a legacy platform, most likely running on IBM mainframes, which is protected by a security envelope, but everything inside that envelope is completely unencrypted. So once you penetrate and you find a way out, usually these things are done through collaboration internally within the organization, but you can simply take the data. In a modern architecture, that simply can't happen. And everything is inherently and dynamically encrypted, and it simply cannot happen. So the fact that that is even allowed to exist is just bizarre to me. And the fact that it exists in every major bank, insurance company, and government agency in the world, as a very simple example.
Does anyone else want to weigh in on that? Would you agree?
So,
You ask me?
Sure.
Yeah, so I think I will take that question in a more broader way. The real issue, if you take China as an exception, keep that away, in the broader ex-China, ex-India challenge is to truly build the core of fintech lies on the digital identity. Everything starts with that core identification of a customer in the digital form. I think this is where I think government has to focus and build a national digital identity strategy so that everything revolves around that as we look at re-architecting the future digital economy. The other piece is shared utilities like KYC. I don't think it is the best interest of every institution to build that KYC. Of course, there's a value on unstructured KYC and other associated KYC using machine learning and all those things. But the core KYC is something we believe should be built as part of the broader fintech or broader digital economy strategy. So that's a piece has to be done as part of doing more about supporting this digital journey. And the third aspect is the data residency. More and more, this is going to be a challenge. And it's going to challenge for China, it's going to challenge for Indonesia, as people are getting more nationalistic about data. And they're going to start withdrawing, making data residency as a policy so that you can't take data out. And most, as Jonathan mentioned, is all a scale game. If you are outside China, where is the scale for a single country? So we need to thoughtfully think how the data residency policy has to be constructed so that we don't restrict this ability to scale and build algorithm to make things better. So these are the three areas I would think as a policymaker, as a public utility, we should think to build or enhance going forward.
Did you want to add to that?
yes, I'd like to answer this a little bit different. It's easy to understand that technology can reduce cost and increase efficiency. We know that for any financial institution, it's costly to acquire customers, to gather information, to assess risk, to do operation and the capital, and assess trust. And so all those things are being fundamentally changed by technology. The mobile devices fundamentally changes the way we get access to finance, and the three things together, big data and the AI and the cloud computing. For cloud computing, it's only 1/10 of the cost of a traditional IT. And AI means that you can learn big data and get insights. So all those things together, that means our cost and efficiency of gathering information and processing information to do KYC is being fundamentally changed. And blockchain is helping us to build a trust system without trust. So we understand the logic. But what I'm trying to say a little bit different is that I think in the industrial world, for most of the time, finance is separated from the use cases. And now because of the accessibility and because of mobile devices, actually finance with you all the time. So it's really one thing to have financial services and a completely different thing to have people actually use it. So that scalability is about the marriage, the seamless combination between financial services and real life cases. So I think that's really the wonder. You can see that when it's very scalable, it's because they combine these two things very well. So just now, I'm sorry, so you asked me what's the difference between tech thing and fintech. So I think we want to emphasize on tech thing because we feel like fintech is almost like, okay, I was using IT, now I'm going cloud computing. It's not cost and efficiency, but it's not just about that. We see that there's a huge chemistry between tech and fin when they're together. That actually has a lot of change. You know, it has a lot of inclusion, and actually it reconstruct the experience of financial services. So we can use another word to describe this. Sometimes we call this a fin life, which is in my view, a more mature stage of fintech is fin life. It's not about the combination of finance and technology. It's about the combination of finance and real life case powered by technology. So fintech is really early stage, but when you're bragging about your technology, that means people are not using it. So a more advanced stage should be fin life powered by technology.
You raised a really good point just now, and that was about trust. and maybe we could just have a quick conversation about this. If I was a consumer looking for any financial product, why should I trust Ping An or Ant Financial over OCBC or Goldman Sachs? What do you think, Simon?
I think the trust, a lot of it is a brand, right? If you look at consumer behavior right now, so let's just zoom in on, let's say, payment and lending, right? Which is the first two products that you see fintech picking up and disrupting, right? These are mostly being used by the early adopters are 20 to 30-year-old young adults, right? And these young adults, I think what we've seen is a slow change in consumer behavior. They no longer want to look for the big old HSBC, Citibank to deal with. It's the brand, the perception of brand is very, very different now. They actually trying to work with brands that give them convenience, socially responsible, is a brand they don't want to be associated with. So the concept of the consumer choice is no longer about trust. It's actually about, do you deliver a convenient service? Are you a brand that they want to be associated with, right? So we always joke that, for example, right, in a lot of countries, Uber is actually not cheaper than a cab. It's actually more expensive. But why do young people want to ride on an Uber rather than hailing a normal cab? It is because they want to be associated with that. So I think a lot of it, right, is the ability of a brand to deliver such experiences and the emotions with the customers. I think that's what's building the trust right now. It is not about having a 100-year-old financial institution that is listed in 5 stock exchanges like that.
Can I quickly butt in that question? I think my point is less about trust, more about empowering customer with the consent architecture. Because at the end of the day, all the fintech companies depend on my identity and my data. So unless I have empowerment through a policy or through some regulation that my consent architecture is strong enough, so I give consent to you so that you can give me a service. And if you don't deliver the service, there's a severe penalty for breach of that faith. If you can build that architecture, I think trust becomes a moot point.
Nintong, how do you build trust at CreditEase?
Yeah, and actually talking about that, I have some different ideas. Like when we talk about like consumer experience, fintech is very different from like e-commerce. Yeah, financial services is term intangible benefits until the benefits come to you, right? So in China, a couple of years ago, you saw like fintech companies offering super good consumer experience of like buying a investment product or getting into an investment opportunity. But if the underlying asset was of poor quality, this kind of like a frontline consumer experience is useless. So financial services is very different from like buying tangible goods. So it's really about like the underlying asset being very solid, right? And also talking about the so-called like the combination of real life events and the financial services. When I'm about to like board an airplane, I buy some kind of like low cost insurance policy. I don't mind like paying a little or paying more than I should because it's like a micro thing anyway, and it's time sensitive. So I need to just get it done, and the door will close right very soon. So then you have like a scenario where financial services like can come easily, smoothly. But when you read about like a investment opportunity, which is like a bigger amount, right? You don't want the consumer to do very emotional spending, like it involves your life saving and so on. Like a 30-year investment started with some kind of like a reading about a good article, like you just do it. You don't do that. You think carefully. You consult your financial advisor. Like it's a very long-term thing. So I don't want to generalize, right? Like a fintech being about a frontline consumer experience. So if there's no good regulation, there's no good kind of like a scrutiny, finance can be very risky. Yeah, so I think we should pay more attention to the logic of financial services, the foundation of financial services, and the risk part of financial services when we talk about fintech.
That's a really nice segue into, I think, our second question that we'll try and answer now. So question number 2 is, what are the points of friction between fintech startups, legacy financial institutions, and regulators, and how can we move the relationship towards a collaboration and partnership? So I think for a long time now, the conversation has been fintech is traditional banking's foe. But what we see now is modern fintech businesses essentially seeking scale, and then at the same time, those traditional institutions seeking some digital expertise. So fintech startups and fintech companies now are offering products that were usually dominated by the bigger banks. Peer-to-peers are offering loans, and robo-advisory firms are offering more transparent and in some cases, cheaper ways to manage money. So let's go into this on you, Chen. First of all, Ant Financial, we know, is the world's most valuable fintech firm. Do you think traditional bank CEOs should be losing sleep over the growth of this sector?
Yes or no? I think no, because actually I'm not aware of a single financial institution in the world that went bankrupt or had a huge outflow of capital because of the fintech. It's not happening yet. So I'm not seeing that happening, because coming back to that point of trust, I think related to human nature, and trust is very important in finance. And so when we trust a bank, a financial institution, we don't really move money around. So trust takes time to build. So because of that, I think traditional financial institutions still have a big future, but they have to change. That's the other side of it. Now, what's the future of fintech like us? Again, we're coming back to that word tech fin. I think, firstly, we want to say technology is important. It's changing the experience. And second, we said it's more than just upgrading of technology. It's actually reconstruct the financial experience, have the financial inclusion. And finally, we see a huge collaboration future between the fintech companies and the traditional finance, because they have different strengths. The future of finance should be customer-centric. And I call this financial life. It should be anywhere. It should be like tap water. Wherever you need it, you just open it. It should be there, right? So it should be customer-centric, and that means organizations have to work together to provide that service. The strength of a tech company is a tech part. It's how to reach the customers and the experience. But the financial companies, they are very good in assessing the risk and designing the product, etc., and the capital. And so together, I think that is really, we firmly believe that's the future. And for us, just because we don't want to become a very heavy traditional bank. We never want to be a big bank. We want to be a platform. We work with the financial institutions together to serve the same customer. I think so. They should work together.
Jonathan, do you agree with that? By basic analysis, fintech at the front, traditional financial institutions at the back. What value can be created when you combine David and Goliath?
Yeah. So I think I agree completely. There's no financial institution that's going to go bankrupt anytime soon because it didn't get fintech. It's just not happening. I think what you're going to see is a much more subtle transition, and you're going to see banks increasingly pushed back. Or those institutions that don't adapt and don't rethink that client experience or client value proposition, actually think beyond finance as to what the client is actually trying to do, and then to actually make finance precisely as was just said, as Long just said, as a seamless, invisible enabler for that. I think you can see with the regulations in Europe to create open APIs for banks. It's the next obvious step is to create layers in front of banks that actually try and make the services seamless and somehow match the agility of new generation enterprises that are totally focused on new ways of solving client problems and enabling clients with the regulated security of banks or other financial institutions. But what's going to happen inevitably in that is that the margins that banks enjoy are going to get commoditized dramatically, and it's going to be a slow process of adjustment to living on much leaner margins and essentially being a fairly anonymous commodity provider of back-end services. You know, banks ultimately will just be an API, and it's going to require them to, make a very concerted, conscious investment in understanding in a new way client needs and the way in which technology can help actually solve client needs creatively. That's really quite independent of the legacy models of delivery.
Do you think banks will go willingly into the sunset?
Well, of course not, and some will try, but many of them are really prisoners of their legacy platforms and systems, and in general, the regulatory construct doesn't help them, so it's not easy for them. And most of them have quarterly earnings targets. Most of them are rewarded for saving money and for not investing, as opposed to investing and solving client problems.
Simon, I wanted to get your take on partnerships as well, because you made a really good point ahead of the panel. Not all expansion strategies are created equal. So as you highlighted to me earlier, Ant Financial using its payment network to kickstart its own expansion, Credit Ease and Ping An both setting up offices in Singapore. What is WeLab doing to expand through local partnerships, and how valuable are those partnerships to you?
I think it also ties in a little bit about the cooperation with banks, right? So what we've seen is this, right? In fact, I think a core partnership makes up of almost 30 to 50% of our business today, which is once we have developed, so WeLab, to give a bit of background, so we developed a big data, mobile big data analytical model, which allows us to underwrite customers and do KYC within like almost 1.7 seconds. So with that capability, we can actually, as a technology capability, we can actually output this to help partners to be more efficient. So in general, right, we work with partners in a different shapes, right? And we find that this is actually the best way for us, right? You think about it as an entrepreneur, the best thing is you build something once and you sell it 200 times, right? If you just build it once and do it yourself, it's not efficient. So that's how partners come in, right? So on average, we work with partners in a few ways. Number one is when we are in the market, let's say in China, we have a mobile app, we have our brand, our customers, so banks just come in, partners come in as a funding partner. The second way is, let's say we work with a smaller city commercial banks in China who wants to distribute online. They're seeing companies like companies on this panel today eating their lunches, especially on mobile distribution online, right? They want to get in part of this as well, but they don't have the system technology to do so. So what we do is we white label a solution for them. We give them the same as what we have today. We change the color, change the logo. In fact, you don't even know that we are behind them. We work with almost about 10 banks in China today, allow them to do mobile lending today, and we do that. The last part is, what we discover is traditional lending, filling up forms, asking for collateral, sometimes pulling a credit bureau, only give you limited data. But with what we are doing, it gives you a wide variety of data, features of individuals. So by just giving them these data, enabling the risk department, they suddenly see a lot more than what they used to see. And the risk teams are very, very happy with that. And it's sometimes very difficult. Think about this, when you go to a bank, it is impossible to tell the chief risk officer that you have a better way to underwrite. But if you tell them, your way is great, but I can give you something more to make it even better. Now that's a very easy sell, right? So we started doing that as well. And what we've seen is this is actually very, very effective. So once you have the core technology growing in, for example, in China, in Hong Kong, and now we're looking at Southeast Asia, right? Through partnerships, become extremely efficient. So what you're looking for is the synergy of qualities rather than looking for equals in these kind of partnerships.
Nintang, partnerships, friend or foe?
Yeah, I think between fintech companies and the banks, my view is banks don't want to become API. They want to own customers.
Of course.
So the key issue is who owns the customer. And the co-ownership structure probably is not going to work that well. I'm not sure about that thinking, although some fintech companies now talk about co-ownership. Yeah, so it's going to be banks, financial institutions really, really wanting to own the customer relationship. And Simon's case is very good. You white label it, right? Like you are the tech partner. But if it's a different relationship, I'm not sure financial institutions like that. So I think fintech companies can fill some holes that traditional financial institutions cannot or do not want to cover. Yeah, so it's kind of like, they focus on their sweet spot, and fintech companies do their sweet spot. That's one model. Another model I can think of is like tech companies really work for financial institutions to strengthen the relationship the financial institutions have with their customers. Cannot be too much of co-ownership. I'm not sure about that model. So depending on the business model, then we talk about how to do the partnership.
Right of reply, am I right? Yeah.
May I add something?
Yeah.
So I think this a sustainable collaboration is the future. And I think right now we're talking a lot in our own view, institutional point of view, B2C. In the future, it has to be C2B, has to be customer-centric. So it is difficult. I agree with Ning, but it has to be the future because fintech companies, they do not have the ability to become a big bank. They shouldn't become a big bank. When you expand your business, become very capital heavy. How can you do that? It's impossible. So you have to collaborate. And I think it is possible because one of the key future of the technology brings to us is to break the boundary of the companies, become ecosystem surrounding the customers. It is difficult, but I believe it's the future. And we actually see a lot of cases.
Jonathan, you want to add something there?
Yeah, I don't really have a different view. I think it's a challenge for banks. Of course, banks or legacy institutions don't want to give up their client relationships. The question is, do they have the agility and the discovery process in their DNA to recreate client solutions at the pace that fintech is going to be able to do that, and to bring new technologies to bear, to anticipate needs and take out friction. And then at the back end, do they actually have the cost structure to be competitive with fintech or with contemporary technology? And I think they're both huge open questions. I think there will be some really good players who look forward and can absolutely do both of those things, but it's definitely not going to be everybody.
I'd like to add one example, maybe making this more concrete. So we have this wealth management platform. There's a lot of big wealth management companies that come up, and we let them to manage their customers, and we provide a lot of the additional tech services, including like the chatbot, other stuff, and they use cloud computing, financial cloud, all the stuff. So actually, it's a platform. We can see funds. They manage. They talk to the customers. They serve them well, and we provide a platform doing. So it's very possible. What I'm saying. Yeah.
I just wanted to get Supnendu's view on this as well. Supnendu, do you think the views of these fintech companies and regulators are in line in Asia and in Singapore in particular?
I think we are more aligned to fintech than the banks. So in many aspects, because they are thinking about customer. That's the starting point. Most fintech do believe altruistically they're serving customers' need. But down the line, they have the scale problem, they have other issues downstream. I think I'd like to restate the discussion around friction. I think in a way, Ant Financial and Ping An are actually an aggregation of many fintech. They have brought together a huge range of fintech and collaborated together, and they're focused almost obsessively on the use case. And if we go that route, I think banks have a good chance. They can aggregate a lot of fintechs within their front office, back office, middle office. And the challenge is how to stitch this together. And to stitch this together, you need an architecture like API architecture to bring it into one single box. And then I think they can be sustainable in this long, cost-effective, great customer experience journey. So that's one piece. The second piece is around I think a lot of people talked about regulation. I think regulators are more and more getting aligned to this need for a change in the architecture. That's the reason why they are also thinking of taking out some of the burden out of the banks in terms of KYC. They're thinking of taking the burden out of the banks in terms of identifying consumers. But these are really, and Jonathan can add more numeric value to that. It's a remarkable, expensive value proposition to acquire customer and validate customer and call the customer 10 times. Did you really come and bank with me? So that entire stack of operating expenses, regulators are working very hard to take it out of that system and build public utilities. So there is a trend which is influenced by the fintech of like of Alibaba and all around me so that we build a real sustainable, long-term, customer-focused, customer-driven financial sector.
Before we put a lasso around Bitcoin and blockchain and take a trip to the Wild Wild West, let's talk about our final question, which is on inclusion. And if you have a look at the numbers when it comes to inclusion overall, I think this is fascinating. Barclays research showing just recently that there's 2 billion people in the world who are still unbanked. That number is probably higher than that. And then if you have a look at the situation in the United States, in cities like Miami and in cities like Detroit, around 20% of homes are actually unbanked in those major US cities. But the trend over the past 5 years that we've seen is that 700 million people went from being unbanked to being banked, and that was mostly thanks to the fintech industry, according to research that was also done by the World Bank. Where is the highest rate of conversion? As you would expect, it's actually here in Asia. So I think that's a really interesting conversation to be had. To the panel, why do we think there is such a lack of inclusion when it comes to the overall finance industry, and what's leading to it?
So I think the very simple the cost structure are absolutely unsustainable for banks to do inclusion today. The cost of onboarding customer, the system cost, the regulatory costs are so high for them to serve that market. So that's the single biggest reason, and which we just stopped at least the banks going there to solve the inclusion need. But I think more and more, as we see, we are seeing different kind of institutions are coming to serve this market, primarily through a digital platform. And more they come to the digital platform, more they build those layers of interoperability, you will see a much deeper engagement to the inclusion market. But I must say something, may not to the best interest of fintech, we are also seeing a new kind of problem, a digital inclusion based on data. Because more and more data fintechs know about you, they may inadvertently start excluding you from the financial services, because our physical personality and our digital personality are two different things. What we search in Google, the world doesn't know. So if they start looking at the digital personality, they may start excluding. So we may see a remarkable growth in inclusion through fintech. We may see downstream a remarkable exclusion of people because they know more about you digitally. And that's where policymakers have to come and prevent that happening down the line. So that's my big concern.
I think financial inclusion, if you think about it, right, the problem obviously was distribution, purely because distribution, if you can only distribute through face-to-face, giving you a physical form, letting you vet certain things face-to-face, right? You can never deliver financial inclusion in a large population. So it has to be done through technology. So I think the point that you raised is very, very interesting, whether it will create a new set of problems where you understand someone better or someone generated more digital data, hence they get access to financial services. Right? I think that's going to be a byproduct of it. It's not something that we can change for now. But I think what is very, very obvious right now is that this is being resolved by initially non-banks. Financial inclusion right now is not being solved by banks. It is actually being solved by the digital payment platforms or online lending platforms where we provide financial services because we don't have the problem of distribution. So I think, once again, going back to the importance of technology, being able to use the technology to do so. And also goes back to what I was talking about, right, which is the next step is banks have licenses. You need to help them to do so as well. So how do you actually give the technology back to the banks to do so?
Just to quickly add on, because very critical for financial inclusion to be long-term sustainable, build a nationally mandated digital ID, build a national repository of customers' information, build a strong consent architecture, rest will follow through nicely. If you don't build this thing, policymakers will need to have access to data. And if they don't have the data access, I think there will be long-term systemic risk.
Gentlemen, your view?
I think actually this debate is a good question. It's really the debate between is it digital divide or digital dividend? But that is an empirical question. It is a hypothesis. From what we see, that the big trend is clearly digital dividend, because across the world, emerging markets develop much faster than the developed world, as far as we can see. If you look at China and India, if these two countries can be covered, that is 1/3 of the world's population. It's a huge chunk. And within a country, we see that we actually have those indexes. We can see that the less developed the regions including in Tibet, in other regions, actually they grow the fastest. So I think we clearly see that it's a dividend. In fact, recently there's a report by the World Bank, it's called a digital dividend, and it shows that I think it's the 20% the poorest people in the world, about 70% of them has a mobile phone. That's the number provided by World Bank. So I think the difference between the digital revolution and from previous revolution is that this round technology spreads so much faster. You know, in the previous technology revolution, it takes like half a century to reach another country. Right now, it's so fast. I gave you already many examples. I think it's definitely digital dividend. But I agree with you. We really have to take care of the people that are leaving behind. Policy-wise, company-wise, we have to jointly make that effort to make this to be sustainable.
Okay, we have about 5 minutes left, so let's talk about Bitcoin and blockchain very quickly. A question for the audience. If you can confidently explain blockchain to the person sitting next to you, raise your hand. Who can do that? We have one over here. Some people are like, what is that? Yes, there you go. So do we think that money will exist in its current form as we know it in the future? Open slather, who's first?
Well, let me take an initial cut. I think that blockchain is an interesting technology. It's actually just an aggregation of 3 or 4 different ideas. So, public-private key encryption, peer-to-peer validation as opposed to central validation, the concept of a distributed replicated ledger as opposed to a central ledger. And that's an interesting idea. It's useful for some applications. It's not useful for a lot of applications. There are many applications in, let's say, even establishing a currency, where most of us who are law-abiding, tax-paying citizens that live in a country are perfectly happy to trust the central bank to be the central authenticator for our currency. I certainly am, in whatever countries I've lived in. I've never had a problem with that. I mean, there is this libertarian sort of theme for the Bitcoin world that says, we want to live in a world where there are no central authorities. Well, good luck to you. Go and live there. Most of the rest of us are quite happy. Do we want, if we had a digital currency, so would we be happy to have it centrally authenticated? Yes. Do we want it to be properly encrypted with public-private key encryption to a very, very high level? Of course we do. Do we have the technology to achieve that yet? Probably close. Maybe not with certainty, and we'd probably need to create a whole bunch of checks and balances into it. So therefore, I think if you say that, Bitcoin per se, I think is sort of the wrong question. Is it possible to use some of the ideas in Bitcoin to achieve digitization of currencies globally? I think that's right. Is that going to happen independent of central banks? And are central banks in any economy going to be willing to give up the levers to control money supply, which is actually what central banks do nowadays? I don't think that's going to happen at all. So I think all of these ICOs are very interesting. It's not much different from taking this piece of paper, cutting up into pieces, handing it around the room and saying, that's the currency, how much are you prepared to pay for it? And we're only going to add one more piece, every week or something from now on. To me, it's almost as infantile as that.
Jamie Dimon says it's a fraud, if you've seen it in the news lately.
I think that will be a Nokia moment for him. Because they're calling Bitcoin.
A Nokia moment, did you say?
Yes.
Wow.
Because it's okay to call it as a fraud, but it's not okay to call it fraud and stupidity. Because that technology has a lot of value, and we cannot dismiss that as a fraud and stupidity.
It's almost like the internet of the 90s, isn't it? And I say this all the time, but no one really understands the genuine capabilities of blockchain yet, right?
I hope he doesn't regret after 10 years that he said this.
That's okay. He's pretty comfortable, I think. So, what about you, Simon? What's your view on this?
I think Bitcoin has grown to a stage where, number one, you cannot ignore it. So now let's figure out how do we live with it, right? I think we're still at a very early stage of figuring out how to live with it. I think the problem right now is in the lack of central bank, in the lack of great security. So I think the problem last year was actually Bitcoin being stolen. This year was actually a lot more than that, right? So I think we now have to. I think we're now living in a world where it's not going to go away. Let's accept the fact, and we got to figure out how to live with it. And I think a new set of challenges right now is money laundering. How does Bitcoin impact the new set of money laundering? How does Bitcoin influence the new set of moving currencies out of China? I think that is actually problems that we as a community, right, need to figure out how to do it. I don't claim that I have all the answers, but I think it's unfolding. I think I'm sitting here letting the story unfold itself. But put it this way, I do not think that a few years down the road when there's a FinTech conference, we'll no longer discuss Bitcoin because now it's fallen from 4,000 to 0. It would not happen like that. I don't think it's going to go away.
Nintang, very quickly, would you accept Bitcoin or any other crypto as a form of payment?
Yeah, I think blockchain as a technology is helpful. We use it in our own business. And Bitcoin is or can probably become a currency, but I'm not sure about the value. Yeah.
I think it's at about, I think
it's a tool, it's a helpful tool, but might not be that valuable as is today.
I think is at about 6,500 Singapore dollars this morning for one piece of Bitcoin. So very interesting conversation, gentlemen. Thank you so much for coming on today. We appreciate it, and thank you all for listening in. Thanks again. Enjoy the rest of the conference.